So I want to talk about the cumulative volume delta because this is something that I keep seeing online, people posting online, and it seems like they necessarily don't completely understand how this tool should be used, or how it's made of, and for what type of kind of environment this is made. Anyway, so most of the times when I see someone posting the chart with the cumulative volume delta, it's obviously over a kind of a longer time frames, which you can see the chart on the screen is a daily chart on Bitmex, and down here there is a cumulative volume delta indicator, which you can see that it's there's not really any sort of a kind of a correlation with price. There are some minor details, but overall, market was mostly kind of a ranging, going up. The cumulative delta was going down. Market then, basically moved back to the all-time high. The indicator, was going up, but overall not that much. Then we had this kind of a huge sell-off. Now it's kind of a bouncing, but the issue with this is obviously let me actually talk about how this thing actually is made and how I think you should be using. I'm not saying that this using it on a daily time frame doesn't work, and there of course can be some sort of thing that I'm not aware about and completely missing, but once I kind of take you through how this thing is built, like why these bars happening on the chart, basically it kind of doesn't make sense to me to use it on any sort of a higher time frames anyway. So it all basically boils down to this thing. This is a depth of market for these are the 10-year German bonds, and you can see that in this blue column, right here we have the limit orders that want to buy. In the red column here you have the limit orders that want to sell, and this doesn't necessarily mean anything. They are just kind of a resting in the order books, and obviously you need a kind of a aggressive participants, which are the market orders that will actively go and buy into these offers, or sell into these bids, because without that, this would be, if there would be no aggression in the market, these would be just kind of a resting orders, but you need people to execute to them. On these columns here, this is not so important. These are just orders that are getting pulled and added to the price levels. So you can see someone added 36 orders. It's quite fast, obviously, in real time, but these are the pulled and stacked orders, and kind of this is the important thing. This is the orders that were actually traded. You can see that someone sold 78, bought 111, and so on and so forth. So these are the actual the market orders, the orders that someone wanted to, for example, sell the 96, and he didn't want to wait, because obviously sometimes what can happen is if you want to sell for example this 96 or 97, you will place your order into the order book, and the market will trade at that price and move lower from there without you getting filled. This is obviously because this is kind of a queue. If you place the order here, you can see, for example, if you take a look a little bit higher, there is a 356 orders to sell here. If you will place your limit order there, you will be then kind of a last at the line. So if market then trades to the level and only 200 orders will get filled, it means that you just kind of get stuck and didn't get filled at all. So people tend to sometimes, you know, execute with market orders because they just want to get in the market quickly. You know, these are usually your kind of a smaller traders who doesn't trade with much of a size, and because if you execute the market order in these bonds, for example, right away, you know, obviously you will get filled, but you are paying the spread. You know, you are instantly one tick, you know, in the negative if you use the market order, which is, you know, if you are trading one lot in this market, the one tick equals to 10 euros. So if you are trading with a one lot, that's obviously something you probably can kind of stomach. But if you are trading 100 lots or 1,000 lots, you know, it's kind of sucks to start, you know, in 1,000 and 1,000 euros negative. So you are much rather to use the limit orders. But basically this is where the delta is coming from. You know, delta represents the market orders that were, you know, actually executed, because this is still just an advertisement. You know, these orders doesn't have to come through. You know, if I would come here and place a 1,000 lot here, you know, it would be sitting in the book, but it would actually doesn't mean anything at all. So the delta, this thing only represents the orders that were executed. And this is a simple footprint chart. This is a crude oil, and I think, yeah, this is a crude oil. And you can kind of see this relationship in these candles. You know, the bids and the offers are traded diagonally. You know, this is something that not many people realize, that the relationship between these numbers is not horizontal, but it's a diagonal. This is a, obviously, due to the kind of a spread, you can see these numbers are not horizontally next to each other, but they are, you know, diagonally. If I'm at here at 01 and if market is at 01, you can see how the price basically stay the same for a tick, but it changes from a bid and the offer. You know, sometimes this price is traded at bid, sometimes it's traded at offer. There is a spread now. But if I'm wanting to buy here, I am using a market order and I'm executing into these 32 at the offer. You know, although market is trading at 02, if I'm, you know, using a market order, I'm buying into the 03. So this is why the relationship between the number is actually diagonal, not horizontal. And you can see that on the left side, obviously, we have the let's actually look at, for example, on this candle. On the left side, you have the sellers that basically, you know, did this once again diagonal move that they, you know, executed to the bid. They used to say that they hit the bid, and, you know, on the right side you have a buyers that lift the offer. This can be a little bit confusing, obviously, because if you take a look at the depth of market, on the left side you have a buyers, and on the right side you have sellers. But if you take a look at the footprint chart, you know, it's the opposite. You know, this is the selling, this is buying. So you can see that on these kind of a lower let's actually take a look on these kind of a lower sections. You know, you have 5 contracts sold, you know, 0 bought, 9 contracts sold, 3 bought. And you can calculate the delta from this. Obviously, if you are going from left to right, you need to put a minus before these numbers. So the delta for this price point, which is a 89.47, is -5. You know, here you have -9 plus 3, that's a -6. You know, for a negative numbers, you know, for example, at this price point, you have a -2 plus 11, which is, you know, 9. This is how you calculate delta for basically each price level. And then once candle is closed, you can see right here that you have a delta for your whole bar. Basically, this delta has 83. There is a 83 delta for basically this whole bar. If I change the settings of this footprint, you know, and I will just add it as a next kind of a number, you can see now that on the left side you have a delta for each level. Like I said, here you have a -5, -6, here you have a 6, and so on and so forth. This is how the delta is calculated for each price, and then once candle is closed, you'll have overall delta, which is basically sum of all these numbers on the left side will be stuck here on the left. So where is kind of your edge is coming from in this? You are basically watching the relationship between a delta and the price action during the day, and you really want to be kind of taking trades only when you see any sort of a anomaly. And why this is a intraday edge? Well, because when this is going to happen on intraday basis, there is not really any new information coming into the market. You are working with something that is happening right now. People who get too long or too short, these aggressive buyers and aggressive sellers, when you see market is not responding for that, they will have to cover. They will have to, it's called delta unwind, when something like this, for example, happens. And this is where in my opinion at least, the edge is coming from, because obviously it's the kind of a only information that you are working with at the moment, instead of looking at the daily chart here. There is so much going on. People who this is really a daily chart, but if you have a large sellers, within 1 day or 1 week, they can very easily reposition, which you will not even usually notice on these daily time frames. There is not this kind of a immediate edge in the execution. And also the markets are constantly changing. The liquidity on this down move here was not same as on this down move here. These are a couple of months apart from each other, so the market conditions are very different. I think here the volumes were much higher instead of this. This is the current kind of market environment where the volume is much slower. The overall kind of relationship is really different in a the market conditions are constantly changing basically. So you want to be looking at the situations where there is not much time for many things to change. You are really looking at what is kind of happening now. And this is, you can see, this is a crude oil on a 5-minute chart, and this is one of those things where I think it's kind of best to be with the cumulative volume delta, because obviously you have a basically two patterns when it comes to cumulative volume delta, which is kind of the same as which is basically the same as any kind of a oscillator or kind of a classic indicator. The first one is obviously when market is let's say you go up and market makes a lower high at a kind of level, and the CVD makes a higher high. This is called the absorption. Okay, because obviously I'm not going to type the whole thing, because obviously market is making a lower high, the price is making a lower high, but the cumulative volume delta is making a higher high. This means that there is a large amount of the market orders buying into this kind of a prior resistance, but market is not responding to that. And there is a second pattern, which is that price makes a higher high, but the cumulative volume delta makes a lower high. This is the exhaustion. This is kind of a opposite of market making a new high, but there are no these kind of market orders. This one, the absorption one, is actually better uh, because as I said, the limit orders are usually the heavier hand in the market. So this is your better case. But this is also something you should be paying attention to, because for any kind of a healthy uptrend, you want to have both market orders and limit orders go hand in hand. When one side is not kind of accepting that, or doesn't kind of agree on these new prices, these trends will usually struggle. When both kind of go hand in hand, it's there is really it's a easy way for market to go. So both of these should agree, but sometimes when this is not going to happen, this is your edge. I know that a lot of people look at cumulative volume delta and they just use it as kind of a trend following indicator. They are just seeing delta going up, price is going up, so they will buy. But in general, you want to see these situations where there is something kind of a inefficient going on. And I picked up this trade in a crude oil because there is not really a divergence. Basically there is a market. It's kind of, you have a divergence to the downside. Market is going higher, delta is going to pull back lower. If you want, this is actually a good trade. I will talk about this in a bit. But on this day I was more of interested in shorting, and as you can see, market is going to reach this kind of level of SR where I wanted to execute. And look at the both kind of price action and delta. You go from this kind of a more stable range calm compression to the upside, to this kind of a fast move to the upside, which is also represented in a cumulative volume delta. This is nothing kind of unusual, because obviously there is no divergence. Market makes a new high, delta makes a new high. This is all kind of normal. But since we are trading into the level of resistance, and since I am interested in going short, basically, this is actually a good sign for me to add confidence to my shorts, because you have all these market buyers buying into the level, and once it gets hit, you can see that price is just completely going to stop. So this is not, the cumulative volume delta is one of those indicators where you need to think a little bit about kind of what is going on in the market and why there is so much buying and price is not responding to that. So once market hits the level, and then you have kind of a small level of support, we're gonna bounce from it, then we're gonna break below it. Once this is really going to start to fail, you can go short in a with using this as a confluence, because obviously all these people who bought this upside, they are in they are losing money at the moment, and most likely they will kind of unwind their positions. They will start closing the longs, which will then cause the price spike down very quickly. In a kind of a addition to that, you have this kind of a slow grinds to the upside, where all these stops from all these long positions basically are having stops below these kind of a higher lows. So you have these kind of a two situations where, first of all, there are a lot of stops. So once market going to start to hit them, you will have this small cascade. Obviously this is not Bitcoin, so the crude oil is not going to dump $10, but you can see this very sharp sell-off. That's obviously caused by all these stops getting hit, but also the people who tried to chase this move to the upside and got absolutely kind of stuck in this, because you can see the delta here in this section is pretty high. So there is a lot of buying that is underwater, and they will have to cover their trades. Okay, this is most likely my favorite way of using a cumulative volume delta, because obviously this one this one was kind of a mean reversion trade. You have you are basically fading the move higher. What is very often easier thing to do is go with the trend. I know most people usually try to fade everything, but the path of least resistance when market is just going down is easier thing to do. This is ES, this is RTH profile only, so there is not that much information, but I just wanted to kind of clear that. You can see at the end of each day how you have these sharp selling of deltas, people usually covering their positions or whatever, but this market is generally in a downtrend, for the last month or so, and on this previous day we traded above this kind of high here. You can see this is one of those things where delta is going down the whole day and market is just kind of slowly drifting up. There will be days like this. This is once again not kind of a be all and end all. Cumulative volume delta will on a lot of days not going to represent the price completely. So that's something kind of worth paying attention to, that you will have days when these things will be completely different to each other, and you need to, so don't rely on this completely. Use this once again as a confluence for your own kind of a system. But yeah, like I said, these are the ones that I like to trade the most when it comes to CVD. For whatever reason, let's say I'm bearish, market traded above this level of resistance a little bit, then it kept down. You have once again this kind of a slow compression to the upside from the open. We're going to fill the RTH gap and then start to breaking down. So I wasn't trading this. I took a trade in the crude oil, but I didn't take a trade here. This is a 10,000 tick chart, by the way. This is not a time-based rotation, but it doesn't matter. So let's say that for whatever reason I want to go short, and market kind of breaks this first level of support here, and you can see on a pullback you have pretty much the equal highs. You have a resistance which we kind of breach a little bit, but look at the cumulative volume delta. The amount of buying that came into the same level is much higher. So this is kind of your absorption in a pullback. You have a basically established trend. Basically, market is going one direction. Let me kind of draw this again. Market will be already trending. So let's say you are picking up in a uptrend. This is your price, and this is your price, and the CVD for this uptrend will kind of go with the price, and then on this pullback it's going to do something like this. Okay, so you will have this divergence where on a kind of established trend, market sellers will all of a sudden kind of really step in and try to shift the environment, which is just not going to happen, and market will continue higher. And this leg then will be much quicker, because all these people who sold into the pullback here, they will start covering their short positions, and it will result in a even faster move higher. So this is really how I like to use the cumulative volume delta. And it's not kind of once again the be all and end all, because you can see, for example, here we have kind of a established downtrend. Market then pulls back just a little bit here, into this kind of level of SR. It's a little bit messy, but you can see once again a lot of buying coming into this leg. You don't need to sell it immediately, but if you wait for one more kind of a SR flip in here, and you will fade this is something, this is what I was talking about. A lot of buying happened, in this area. These buyers are underwater. They will have to cover their positions, and market will completely change the pace and just flush lower. And once again, this is a intraday tick time frame. There is not uh, much of a kind of a new information that can step into the market. This is why I think this thing works best on a intraday chart, because obviously if this would be kind of a multi-day thing, and I already explained this in a previous video and kind of showed this example before, but let's say that you I hope that I will kind of draw this well. Let's say that you have this, once again, this relationship between price, which is going to do something like, let me just try to figure this out. Okay, so let's say something like this, and you are making kind of a decision on your trade here. So this is your price, and this is your CVD, and the CVD is going to do something like okay, let's say this is your CVD, and a lot of people will look at this is let's say like H1 time frame, and this is your Monday, this is Tuesday, and we are coming basically into Wednesday here, and people will basically look at this and say that market made a higher high here, but the cumulative volume delta is not making that same higher high. So it's a there are no new market buyers. There's just a exhaustion in the market, and this will go lower. But what do you had this kind of a huge downleg to the downside, which on a kind of a equal low pullback happened. So the shift in dynamic here is a little bit different, and since you are really giving this much longer period of time, it's much harder to kind of understand what is intention from these buyers and sellers on kind of a multi-day time frames. It's yeah, like I said, use this as a intraday indicator. At least that's what I do. The last thing, the exo charts. This is Bybit. The crypto market. Obviously, you have all these different exchanges. You have some tools that will aggregate these data for you. I look at Bybit because I think it's the biggest kind of a retail exchange. So all these YouTubers and everyone is doing the best they can to shield their ref links. So you have a lot of retail traders trading on Bybit. So these kind of inefficiencies where market buyers and sellers are aggressively kind of stepping in and price is not representing that are going to be very obvious on Bybit basically. One of the other things, this is the BTC USDT chart. I recently looked at Bybit, and this thing has actually more volume than the inverse contract. So if you are trading on Bybit and you were looking at the BTC USD, it's kind of worth to consider switching to this if you or at least give it kind of a try. So this, once again, very simple thing, and it's crazy how obvious this is on Bybit. A lot of times, once again, if you have any kind of a system, for example, if you would be scalping, you can trade most of these. I don't. They have to fit my kind of overall system and overall bias, but you will see these divergences, or these kind of inefficiencies extremely very often. So, market is making a higher low, delta is making higher high, a lot of buying came into this leg to the upside. Market is not representing to that. Shortly after, they will have to unwind these positions, with this large sell-off. Today, this is the blue line is a VWAP market, is going up from the open. Then we're gonna have a pullback into the VWAP, and look at, you know, this kind of a amount of selling that came to this. Once again, it's not really represented in the price. You can, you know, trade this as kind of a pullback to the SR with the VWAP. Once you see market turning with this kind of candle with this wick, you know, you can use footprint for confluence or whatever. You can take a scalp long to the new highs. You know, this is a very simple situation. Once again, you know, large selling on the pullback. If there is something else, you know, for example, this was very short-lived, but you can once again see this high large flush of a delta, and this is not necessarily any kind of a divergence, but if you think about these things for a little bit, you know, you have this amount of selling, went under this level of SR, but market breaks above. You know, these sellers are now in pain and they will have to start covering. So once we retest the level here, you know, you will have very short bounce in price, and then, you know, more down, but, you know, the idea is still valid, you know. And kind of one last thing is, once again, this is not really anything too clear, but you make a equal highs and delta is a little bit higher here, but this is not kind of a cleanest one. So let's just kind of end it with that. I think that I covered basically everything there is to the delta, or at least what I do, you know. Really, I am looking at the situations where it's very obvious that one side is really stepping in, and I am looking at how market is kind of reacting to that. There are more things you can do with the cumulative volume delta. You know, you can see these shaded backgrounds. These are the single bar delta divergences. You know, this is something that obviously if you have a, you know, you can see there is a lot of them. Let me just try to find something which is a little more obvious. You know, for example, this one, you have a candle that is closing, you know, up with this kind of a long wick. You have a negative delta on the bar. You can see if I zoom in, you know, minus 354 basically on a high volume. So this means that there was a more selling than buying in this candle, yet, you know, it closed up. So this is your single bar delta divergence. Once again, you will get a lot of them, but you can see how a lot of these are just kind of a small candles. The minute this candle will be actually bigger like this, it's kind of a worth start to paying attention to, you know. Really, you wanna, once again, looking at these kind of extremes, you know, you wanna have a large buying delta in a candle. For example, this candle would be great if, you know, it's this one with the divergence. If it would really close down, or if it had a kind of a huge wick to the upside that is taking any kind of level of prior resistance, for example, you know, this candle is not really something crazy, but, you know, once you would see the single bar delta divergence, you know, when these things would be really obvious, you know, huge down candle or huge wick above the prior resistance, you know, with still more buying in the candle, that's your good signal. You know, picking up every single one of these, you know, is not really the best way to do things, basically. The last thing with the cumulative volume delta you can spot is basically when you have a, let's see if I can find this. I rarely use this, but it's actually worth to mention. If you have something like, let me increase the size of this a little bit. Well, it's not something that I see right now, and I'm not going to spend any more time to finding the example. Like I said, I'm not really looking at this too often, but basically imagine that there is this kind of a unusually, you know, large candle basically here. It's a huge up bar compared to basically anything else you see on a chart. The delta here is kind of equal to that. There was a large kind of buying into it, but imagine if the cumulative volume delta candle would only look something like this or this. That would mean that this move up was driven by the limit order book, which happens from time to time. And obviously, as I said, the limit orders are kind of a heavier hand in the market. What you will often see is that market orders that are later removed, because like I said, those limit driven, basically they will start aggressively buying to the somewhere around here, and market will just quickly move higher. These are hard to catch because you often don't have much time to jump into that trade. You will have this small delta on this huge up bar, and then market orders will just pick up to that, and they will start to kind of a chasing the move, and market will move higher. But this is not the case. There was a equal amount of market buying, and market pulled back before making one more leg up. So just one of those things you should be looking at. But like I said, the most important thing when it comes to the cumulative volume delta is understanding, or at least for me, is kind of a short-term tool, because I am working with the immediate information in the market. The people who go heavy on one side or another, as this is happening during the one trading session or trading day, they are about to cover sooner or later. But if I plot this over a couple of days, I can be missing a lot of important information, or just complete kind of shift in a market narrative. But if you are looking on a lower time frames, obviously this is just the thing that is happening right now, and you can benefit from that in a short-term manner. This is also what is worth to mention is, obviously, if you see one side going a heavy during the intraday time frame, it doesn't mean it will start a 2 month of a uptrend or downtrend. It's an intraday thing. You are taking things to next intraday level. You are not running every single trade, because there were more aggressive buyers than sellers in kind of a short term price lag. Okay, so I know this was a long and maybe a little bit boring video, but I wanted to talk about this because, like I said, I might be completely missing something when it comes to using this thing on a higher time frames, but from my best belief and how I've been using this tool in both kind of crypto and legacy markets over the years, this is kind of a best way to do things, not following any kind of a strict divergences or anything, but using it for both mean reversion and trend following on a intraday time frames to have this kind of a overall idea what what the aggressive side is doing and how well it's working for them, basically. Okay, so that's going to be it.